Prop firms don't fail traders because they're bad at entries or exits. They fail them with math. Every futures trader knows the difference between micros and minis. But here's the dirty secret. Lot limits and trailing drawdowns make minis too risky and micros too slow, trapping 90% before payout. In this video, I expose the hidden lot sizing math they don't tell you, and give you the strategy to build cushion with micros, scale smart with minis, and finally turn prop firm rules into profits. Here's the difference between minis and micros. Minis like ES and NQ are full-size futures contracts, each tick worth real money and real risk. Micros, MES and MNQ, are exactly 1/10 the size. Safer, but slower. Prop firms use the same lot limit rule on both, which means your exposure explodes with minis and crawls with micros. And that math decides if you survive. Here's the core difference between trading minis and micros. On the NASDAQ Mini, one tick is worth $5. With 5 minis, that's $25 a tick. Just a few moves can cost you hundreds. On the micro NASDAQ, MNQ, one tick is only 50 cents. 5 micros equal $2.50 a tick. Safer, but far slower to hit profit targets. Prop firms cap lots the same on both, but the exposure is completely different. That's why knowing this math is critical before taking any evaluation. Let's run the numbers on the NASDAQ Mini, the NQ. If you're trading 5 minis, each tick is worth $5. That's $25 per tick total. A simple 10-tick move in your direction gives you $250. Do that 12 times, and you've hit a $3,000 profit target on a $50,000 evaluation. Sounds fast, right? But here's the flip side. The math cuts both ways. The same 5 minis going against you by just 10 ticks costs $250. Stack up 8 losing trades like that and you're down $2,000, right at the edge of most prop firm drawdowns. So while 5 minis can help you reach the profit target quickly, just a handful of bad trades can blow up the entire account just as fast. That's the hidden danger in sizing minis. Now let's see how the math works with the micro NASDAQ, MNQ. With 5 micros, each tick is worth just 50 cents. That's $2.50 per tick total. A 10-tick move in your favor? Only $25. To hit a $3,000 profit target on a $50,000 evaluation, you'd need about 1,200 ticks. That's roughly 120 trades. Safe, but painfully slow. On the downside, the same 10-tick loss with 5 micros is only $25. Even with a $2,000 trailing drawdown, you'd need around 80 losing trades to blow the account. Micros give you survival and breathing room, but they stretch out the grind, making it hard to finish evaluations before fees and resets eat you alive. Here's the reality that surprises most traders. Passing an evaluation doesn't mean the rules disappear. They follow you into your funded account. Your lot limit and trailing drawdown still apply, which means the same sizing math can wipe you out. On top of that, most firms add consistency rules. You can't make all your profits in one big day. The trailing drawdown moves with your equity, shrinking your cushion as you win. And even if you survive, payout rules often force you to wait weeks before you see a dollar. This is why so many traders celebrate passing but never collect a payout. The rules don't go away, they get tighter. Strategy 1 begins with trading 2 micro contracts. If you win, take another 2 micros. If you lose, that's okay. Just take a third micro trade anyway. If you win that third trade, it's time to scale up to 1 mini contract. And if the mini trade wins, stop trading for the day. This methodical approach lets you build confidence, protect your account, and grow steadily without rushing or risking too much too soon. Strategy 2 starts with 2 micro contracts. Win your first trade? Take another 2 micros. Win again, then step up directly to 1 mini contract. If you hit your profit target on the mini, stop trading immediately. This approach blends cautious micro-scaling with a quicker transition to minis, balancing risk control and faster growth. Strategy 3 starts with trading 2 micro contracts. If you win, take another 2 micros and keep going. If you lose, don't worry. You're still at break even. Take another trade with 2 micros. But if you lose this third trade as well, stop completely. Protecting your capital is your top priority. Avoid chasing losses or doubling down. This strategy enforces strict discipline and tight risk control to safeguard your account under pressure. Strategy 4 begins with trading 2 micro contracts. If you lose, take another 2 micro contracts. Lose again? Take one final 2 micro trade, and if that is a loss as well, then stop trading for the session entirely. Avoid the temptation to jump to mini contracts to recover losses. That's the slippery slope of revenge trading. This strict stop-loss discipline is designed to protect your capital and keep you in the game for the long haul. Want to see which firms have no scaling or how account sizes compare? Just head over to rankpropfirms.com and check out the comparison page. You can filter by account size, select scaling as a comparison type, and quickly see which firms do or don't have scaling rules. It's all right there, so you can find the perfect fit for your trading style.
Your next step? Head over to rankpropfirms.com. Check out the side-by-side comparison and grab those promo codes before you jump into your next challenge. And if this video saved you some time or money, do me a favor, hit that like button, subscribe, and turn on the bell so you don't miss what's coming next.